Well, let's get started. First of all, thank you so much for joining us today. We are really excited to present a new opportunity. This one is located in Albany, Georgia, and it's a three-part portfolio. It's 131 lot value add in a landlord-friendly market. My name is Vinny Carius, for those that don't know me, and I am one of the co-founders of WCG Investments. And today we'll walk you through why this is such an attractive investment. We are really excited about it. So we'll look at property fundamentals, the business plan, projected returns, and we'll touch on the team's proven record, track record that is. So yeah, Tim, next slide, please. So before we dive in, just a quick but important note. This presentation is for informational purposes only. So it is not a solicitation or securities offering. Any investment decision should be made after reviewing the full PPM. And our goal for today is to give you a clear understanding of the opportunity so you can make an informed decision. So next slide will show you the team. Tim Woodridge and Matthias Grunwald, please introduce yourselves.
Hey, y'all. I'm Tim. I've been doing in the mobile home park business for almost 6 years. Yeah, December will be 6 years since I bought my first park. I'm a retired nurse, and I am super nerdy about everything affordable housing. I see the big opportunity for everyone. So yeah, thanks again for being here.
Hey everyone, Matthias Grunwald here. I'm originally from Germany. I moved to the US about 13 years ago. Lived until yesterday in Greenville, South Carolina for the last 13 years once I arrived in the US, and just relocated yesterday in Tampa, Florida right now. So fulfilling my dream to move into Florida, based out of Tampa going forward. So that's why my background is blurred, because it's a complete bombshell I went off behind me in an entire house. So I literally just put my desk here to get it started with this webinar. So I'm a retired chief operating officer. I have 18 years of experience in operations for automotive manufacturing. So operations in my blood, streamlining processes and running everything efficiently is what I do all day. I run my life like it. So I've been in the real estate industry for the last 5 years. Started with a small duplex and then scaled up to a fourplex and flipped that one, did the Burr method on that one too, and then got into 26 unit apartment complex, 27 unit RV park, and then started partnering with my co-founders here and partners Tim Woodbridge and Vinny on the mobile home park side. And since then we scaled to over 19 mobile home communities that we now own and manage. So very nice to have you guys today. Looking forward to going through this deal with you.
Okay. So again, I'm Vinny, and my wife, Marianne, we work on this together. It is a family business. We have a 7-year-old, and yes, she works as well. And let's see here. So my journey was a little different. I was focused on research, got a PhD in biomedical engineering, manager at a national lab, and I lead teams. So I'm really good with people. So my focus is, investor relations. And my wife, she does pretty much a lot in the background. She does a lot of the due diligence. She helps a lot with the investor relations as well. Asset manager, whatever, she has many hats. So I'm really happy and grateful for her. And we also have Jaden Smith, and he's another experienced operator with 8 years of experience. And we are really excited to be working with him. This is a really good team. And yes, again, if you can't tell, we are really excited, and we can't wait to close on this deal. And hopefully you guys can join us on this journey. Next slide.
Before going, I just want to say about Yaden. So I met Matthias and Vinny through the deal room, through Yaden and his cousin Jennings group. So for him to come back and say he wants to help us in this project, that was that was a very proud moment for me.
Yeah, it's like a family reunion, isn't it? All right, so how does this work? This is our process, right? So we find the deal And we underwrite it. We make sure it's a good deal. We make sure the cash flow is A1. Main criteria is that it doubles investors' money within 5 to 7 years, right? So the investors, provide soft commits. They go into our investor portal, provide a soft commit, verify accreditation, and sign documents. That's when you get you review the PPMs. We manage everything, and you collect distributions. So we have, before this deal, we used to give out quarterly distributions, and that is one new change. We are moving to monthly distributions. That works out nicely for our investors. That way, you get that consistent um, funds, right? So let's see here. We we don't just we don't just close and we go quiet. No, you get monthly reports on how the asset is doing, right? We provide the good, the bad, the ugly, fully transparent. So you get the monthly reports with the financials on how everything is panning out. Um, Yes, we align interests, you gain confidence, so your capital is treated with utmost respect and integrity. We pride ourselves in being fully transparent. So, and then we will build value. So we add value to the asset. We'll talk about the business plan for this particular park. But that's how the business works. We are committed to growing your wealth and to be completely honest and transparent from beginning to end. Next slide. Yeah.
All right. So what we love about mobile home parks. So yeah, kind of like I was saying earlier, there's such a need for affordable housing, and we're very, very bullish on this asset class because the need is just getting bigger and bigger and bigger every year. And the interesting thing is that the amount of mobile home parks is pretty. It's not going up. If anything, it's going down because people are redeveloping these affordable housing mobile home parks because there's a lot of highest and best use. And so we see that opportunity there, and we want to be able to provide the affordable housing to people. On top of that, the thing that really grabbed me when I first heard about mobile home parks is low operating costs and the low turnover. I mean, geez, in one of our parks, people have been there for 5, 10, 15, if not more years. And it's because the need for affordability is there. I love the stable tenant base. I love the stable, the low and slow stability in these parks. Then other than that, yeah, like recession resistant when COVID hit, and then no one was paying all these big apartment complexes, and they were getting hit from all angles. We were doing just fine. I didn't see any drop. I have lots of friends in mobile home parks. There's like no real drop, because the thing is, if they stop paying, there's nowhere else to go that's going to be as affordable to them. You got your forced appreciation. I mean, like with anything, we go in there, we operate it a little bit better, we decrease expenses. All of a sudden, our NOI, our net operating income's higher, which translates to a higher value of the mobile home parks. And then something I didn't know about when I first got into it, but I learned a couple years into it, was the crazy tax benefits that mobile home parks have. I was at a conference and I met, I was at SECO, a conference, and I met Eden with Madison Specs, and we just got to talking, and they do a lot of cost segregation studies. And he said, yeah, mobile home parks get the most of any commercial real estate asset. And I said, that's no way. All of it's land. That you must be lying to me. And he explained, he's like, because it's all land improvement. So it's all 5-year and 15-year schedule depreciation. And for a while, like I still don't know exactly what that is. I don't have to know. He knows, our CPA knows, and it translates to last year or this year. I was going through last year's K1s, and I remember seeing someone who invested $100,000 got $150,000 write off on their K1. So I don't have to know the ins and outs. I just know it saves people a ton of money. And then our track record. So like I said, we've been in this game for going on 6 years. We have a lot of assets, and in fact, we got to update this because we have a few new ones to this. The big things to pay attention to. So we have a lot of stuff that is distributing, that is producing cash flow. There's a few that we're still stabilizing, that we're going to stabilize before sending cash flow, but those aren't ones where there's investors. Those are ones that we took down with our own money to make sure that we could run it well. So no one's not getting distributions. We're just doing what we need to do for our own assets. And then the 2 exits we've had, it was Faulkner Mobile Home Park, which I love that mobile home park. I loved it so much. Everything was great about it. I didn't want to ever sell. And then someone said in like a year, they said, hey, I'll give you more than what you were projecting at year 5. So we're projecting, I think, $1.4 million to sell it at year 5. And they said, we'll buy it for 1.6. And I said, write me a check right now. Let's do it. And so we sold, and we all made a lot of money. And then the other one that we have sold is Carolina Estates. And this one we got into, I thought it was going to be easy, and it was kind of going to be a home run, kind of like my first park where I bought it. And then within a year we refied, the value more than doubled. I thought the same thing was going to happen with Carolina Estates. And the thing is, I learned a ton in that you got to raise the money. You got to have money to do all these capital expenditures. You can't just use cash flow for it. And so it was, it was a costly lesson learned. I could have made some money on it, but one of the partners would have lost some money. So we all kind of just decided, hey, let's just all walk away with our cash back. So no one's losing money, and we're just walking away. We live to tell the story. But anyway, the big thing I learned is we make sure to underwrite that we're we're raising money so we can do the CapEx and so we can do the business plan. It taught me to make sure that we're doing that right away. Otherwise, these deals will limp along and it'll just be a pain. And so it was one of those deals that it was definitely a really good learning lesson, and that we take to heart for everything.
Perfect. Thanks, Tim. So yeah, this is an exclusive offering. And what that means really is this is not an on-market deal. This was never listed. This was never provided to us by a broker. This is completely off-market, brought to us by a wholesale company that we have a really good relationship with and that we've been working with for a very long time. And we do a lot of offers. So between Tim and I, we really have this acquisition machine really running really well. And there almost no time passes until we have about 100 offers sent out in really no time, within a couple months. So we always send very creative offers out, cash offers, etc., and build relationship with brokers, with wholesalers, etc. And probably like only 10% of the ones we actually sending offers on, we get on a contract, and maybe a fraction of those we actually close because of the tight due diligence that we're doing on our deals. So this is one of them. This is one of them that survived it all. The very tight underwriting, the conservative underwriting, the due diligence just ended a couple of weeks ago. I was personally on site at the property with our property manager in Albany, since we have a team there already. So we discovered everything that needs to be discovered. Everything has been checked out so far. So what we've seen so far has been mismanaged at the moment in a way that is different than usually. Usually it's mismanaged because it's been completely ran to the ground. This one is not that way. This deal is more they didn't extract all the value yet. They did a lot of cleanup. They demoed a lot of homes. With demo, I mean they really took them down and removed old mobile homes. And everything that's still there right now works really well and is occupied. Every single home that's there is occupied or has an owner to it that pays lot rent. Collections are super high, very low delinquency within a couple percentage points, 2 or 3%, which is extremely strong. But the rents are lagging. That's what I mean with the value hasn't been extracted. The lot rents are on the 300 mark, 290 to 305. They're not all the same for all the tenants. So they're extremely lagging behind market rents. And those are the best deals, really, because if we do nothing but just increasing rents slowly to market rents, we're extracting so much value on paper where we can really give the investors great returns, obviously. And we not only just increase rents in this case, we're raising capital for improving the communities, obviously, because we passionate about affordable housing and provide, safe, clean housing to people. We want to have the parks, representing our culture as well. So we do upgrade the common areas with landscaping, tree trimming, tree removal, which is a big one there. And there's the big southern Georgia pine trees are down there. And some of them, need to be taken down. So it's really expensive. That's part of the CapEx as well. So we don't crushing homes if there's a storm coming through or something like that. So with the gradually raising rents, we do that incrementally over the next couple of years. So our plan is to be at market rents around 3 to 4 years. And then that's today's market rents. So if we see that the market takes off and there's now a run of inflation, we can't really bank on that, obviously. Nobody knows what's going to happen the next couple of years. So we just go by what's rents today. And then rents right now, we have 2 parks in Albany, Georgia already, and we get lot rent $450 to $475 all day long. No problem whatsoever. So these parks right now lagging $150 to $175 lot rent for every single unit at the moment. So that makes us really excited about offering this great return here, because that alone is a major value add besides all the other value add that we're doing. If we move to the next slide, there's also more details on the breakdown here, why we love this deal. The reason why it's sort of stable right now is also because it's the holy grail of mobile home park operating and investing. It's mostly tenant-owned homes, which means they're really expensive to move. It can cost $10,000, $15,000 to set a new home into a new mobile home park by, taking it apart, or at least, dismount it from the pad it's on, shipping it, mobilization at the new park, getting permits. Every city, county is different. In our market, in Woodruff, South Carolina, they wanted almost $8,000 for the privilege of tap into their sewer system. I mean, some are crazy. So it can easily cost up to $20,000 to move a home. So if somebody is living in a home in our mobile home park and they have a tenant on a home, it's very unlikely if we increase rents, especially within the window of going to market rents, that they're gonna just get up and leave, because it's cheaper to pay $50 more a month than spending $20,000 to move a home. So that's why we love it so much. We have 11 units right now. They are rent to own. Rent to own is the same as like lease with an option option to purchase. That is, so they're on long-term contracts. They pay an amount above the lot rents, and this is the amount that they're paying the home off over time. They're running out over the next couple of years. Some of them are next year, some of them are 3 years from now, but it doesn't really make a big ding on the financials because it's a smaller fraction of on the overall unit count that's occupied. But the good thing is, if they're on rent-to-own contracts, we don't have to pay for any repairs and maintenance. It's all the responsibility of the tenant that does the rent-to-own. It's the same when you get a mortgage with Chase, Bank of America, you name it. You're not going to call them and say, hey, my toilet's leaking. They're like, fix yourself. We gave you a mortgage. Now it's yours. So it's kind of the same principle here in really simple terms. We have a strong local presence. Like I mentioned, we have 2 parks. They're on Albany. They're all within 10 minutes from each other. And we have a property manager, which is born and raised in Albany. He knows the market really well. He knows everybody. He knows the judge. He knows this person, knows that person, everybody. So he takes care of our other 2 parks, and he will take care of these 3 parks as well. So we have 131 lots here, as you guys know, and 47 of those have vacant lots. So the plan is here not to infill all the vacant lots. That would require a lot more capex. And we actually, if we just go with the plan that we have planned here, is to put 2 homes per year into the park starting in year 2. It's extremely conservative. We don't have to put a lot of pressure on operations, because infilling is a lot of work. We have to negotiate and work with the manufacturers. We work with Clayton a lot. There's others out there, but Clayton's our favorite. Getting all this figured out, and also getting in place on pads that are ready. We don't have to make sure that all of the pads are ready, because we only need a few, because 2 per year. We need about 8 to 10. Also, they need to be ready out of 47. And we already highlighted those while we were on site, which sewer lines and connections are ready, which meter boxes are already there, which meter boxes need less work. So we know exactly where to tap in, which keeps the CapEx cost lower. There's still CapEx needed, of course, but it keeps the expense low and puts less pressure on the infill process, because that's the hardest process really in mobile home park investing, and also in the value add mobile home park investing, is the infill, so to speak.
Okay, so here's just showing some pictures of 2 of the parks. All right, so Albany is a business-friendly city in the Southwest Georgia. It's a pro-investor, pro-business environment, no rent control, minimal regulation, and strong tax incentives for investors. And the area is a very low cost of living. So it's a young median age of 35, showing the workforce growth potential. The county has over 82,000 residents. Data shows that there's a slight decline in population. However, there's a high demand for affordable housing in this county. And as Matthias and Tim mentioned earlier, we already own 2 parks in Albany, and we show that it's stable. And yes, we can see the need for that affordable housing. And we're positioned to serve that demand responsibly and profitably. All right. So as you can see here in the map, Sands Mobile Home Park, which is one of the parks, is very close to East Park Mobile Home Park, and very close to that U.S. Marine Logistics base. The third park is around 7 miles away, which is Dixon, as you can see it up north. There's a super Walmart up the streets from Sands and East Park. Every time we look at mobile home parks, the first thing we do is, hey, where's that Walmart? Where we want to make sure that we have a nearby Walmart. And as you can see, everything is centrally located, where the residents can find groceries. There's a Lowe's, fast food, you name it. So it's not that small of a town. So yeah.
I like looking at this map right now. You can see Mock Road. So that's where one of our other parks is. And then Mercedes is just kind of right around there too. So we're not that far from these parks.
Yeah, you can see the airport down low too. So it's not a tiny town there. There's a lot.
Yeah.
Also to expand on that, like Sands and East Park, they're right next to each other. There's other mobile home parks next to it too, which is also goes into the point of risk mitigation also. There's a park neighboring next to ours, and when I walked everything, I checked out the park. Of course, you always want to check out the competition, right? Because everybody's fighting for tenants, obviously. So we did that as well. And we heard from the community manager that's currently on site that manages all 3 of these parks that we talk about here today. That a California buyer bought that park next door. They were also like $350 or so lot rent. They went to the $475 right away, and they're pretty much full on the other park. So, and they're really shocking the system that way. We don't like to do that. We not go more than 75 per year up, which is also a risk mitigation mechanism for us, because we don't want to shock the system. And to my point earlier, people don't have the money to move, and then we don't want to force people into a corner and then we're gonna be like, sorry, that's what rent is. We're going to evict you now. We take possession of your home. That's not what we want to do. So we go up incrementally for that reason, to make sure we not all, it's an ethical thing to do, to go slowly up to market, not just in one step. Some do it, they get away with it, but I'm sure there are people that lost their homes. We're not doing that. So it's also tied of risk mitigation, which keeps also the collections rate very high. And also there's people with fixed income in those parks, and in general in many mobile parks there's people there with fixed incomes. So you want to, gradually increase the rents there to make sure you're not really hurting that tenant base, and keep the collections high. And that's the main reason why the collections are really high right now, is because of the fact that they have really low rents. I mean, they're probably the cheapest deal in town right now, which is a good thing for us here and for our investors. But that's the main thing. So other management risk or poor management is a big risk that you have on managing mobile home parks. They have, especially with a lot of tenant-owned homes, they have a very low rent amount, right? So you talk about $300, $400 lot rents. So if you want to go to a third-party management company, they're going to charge you at least 12 to 15%, or even more, because I mean that time costs a certain amount per hour, and if they're only receiving $400 per lot, or even less in this case, they're going to charge a much higher percentage compared to apartments where it could be 12, 14, 15, or whatever, $100 or 2,000 plus in other markets. So they charge a lot more. And as everybody knows, nobody cares more about the property than yourself. And the third party management usually doesn't do as good of a job as yourself because you care more. It's just how it is. So we have our in-house property management in place. So Tim and I run a property management company which manages all the parks we have in our portfolio, and which has a back office as well, right? And in the back office, we have trained virtual assistants. They are focusing on leasing, collections, maintenance requests, and they coordinate with the community managers living on site. So we have an on-site manager. It depends on how fragmented the parks are. In this case, they're so close to each other that one manager manages all three. In other case, you might have more than one, but in this case, you have one on-site manager. And then the back office feeds information to that person. They can also make phone calls and call vendors for that on-site manager, which is super helpful. So, and again, vacancy, there's a very low turnover risk because of the high tenant-owned home ratio. So that's usually always a big risk in multifamily and apartments. There's a lot of turnover, especially in some areas. Especially, we are very aware of the Albany market dynamics because it's a declining population slightly, but it's still declining. But mobile home tenants are very, very sticky, super, super sticky, which helps you a lot to mitigate risk.
What's interesting too, like the park that's right next door that was bought by the California buyers. I don't know for a fact, but I've heard that I'm pretty sure it's one of the biggest buyers of mobile home parks in the whole country. So, you know, there's definitely interest from people in the know who are much, much bigger than us that are interested in Albany. So that gives me confidence in this market as well.
Absolutely. Thanks, Tim. Investment highlights. So the purchase price is $2.76 million, which is about $20,611 per lot. So we always like to look at like mobile home parks. If you buy one, if you want to do like a back of a napkin number, that you want to be around the 100x rule or less. Meaning, if lot rents are 400 or so, then you can pay up to $40,000 a lot, roughly. It's kind of like the 1% rule in single family homes, right? If you get $1,000 of rent, you shouldn't pay more than $100,000 per home. Good luck. Probably don't find it anywhere nowadays, but it's how it used to be. Probably more like 0.75% nowadays in single family. But it's a similar rule. So here we are about half of that. It's like having a 2% rule, so to speak, in single family terms. We have a total of 131 lots, as we discussed earlier. This is a 5-year hold period. We target a refi in year 2 to return 100% of the capital, and everybody stays in the deal and receives cash flow. At that point, it's infinite returns. So in the meantime, you're getting cash flow, you get distributions, and again, we changing on this deal is the first one where we're changing it to monthly distributions after 3 months. We used to do after 6 months quarterly distributions, so we actually reeling that in so much earlier because this one's cash flowing so well right out of the gate that we can do this, and that's what we're trying to do going forward and also in the future. So the refi is subject to market conditions, though, so I want to be very clear about that. If the rates and the capital markets are not favorable in 2 years from now, we might refi in year 3, maybe even 4. So we're not going to put our back against the wall and say this deal only works if it's refinanced in 2 years. Now, in the meantime, if we don't, you guys are going to keep your cash flow. It's going to go up because we increase rents, we reduce expenses, and then we refi when the market allows us to refi smartly. That's the important thing. You just don't want to refi and just like plan on it and just whatever the rate is going to be at that time, and whatever the capital markets are doing, we're not going to go that way because we want to be more flexible. So all the metrics we're going to talk about here next, they're not considering the refi. They're not projected the refinance numbers in there. That's really straight like a 5-year hold, worst case scenario, if you will. So if you refi earlier, your IRR is going to be through the roof because of time value of money. You get your money back earlier and keep cash flowing. Whatever returns you're seeing on this deal, they're actually going to get accelerated and increased because of that fact. Lastly, total equity raise is $1.5 million on this. That's total offering. We started offering this to investors about like a week and a half ago, guys, and we are 2/3 already soft committed from people in our portal. So it's about $1 million we have out of the 1.5 already. It's wild. And I know it sounds like, one of those sales pitches you see on TV, like better buy now before the price goes up. It's really, we have so many people interested in this deal. It's pretty crazy. So we're really happy about like the interest in it. We are probably locking this up in the next couple of days, within the next week or so. So, it's such a strong deal, as you can see in the next slides on the returns. So, just to break down the funds and how everything works. So the investor equity is 1.5 million. And then with the bank finance what comes in, the total cash is 3.4 million that goes into the deal. And then how that purchase price breaks down, and also the member cash to close number. We have the loan amount is $1.9 million. We already got that term sheet from 5-Star, which is a big lender out of California. And they're really heavy on mobile homes, and they gave us a phenomenal rate, and they gave us a commitment letter and everything. So we're good to go there. It's 70% LTV, and we're going to talk about this in a second as well. And everything is good to go there. In the mid sixes, high 6% rate. So that's really, really good. That requires a down payment of $828,000. CapEx for the park is $174,000, which is for road repairs, tree removal, like I mentioned earlier, new signage, landscaping, etc. That's up pretty quickly. And also get some of the paths ready that we selected where we're going to put new homes in. So like just a new meter box and get that ready is like $3,500 to $4,000. So that stuff adds up pretty quickly. Then the capital expenditure for infill. This is the capital that actually buy new homes, finance new homes. All the setup costs and etc. are baked into this. This is a very conservative number. We probably get away with in $100,000 to $125,000, $150,000 mark. But we like to have reserves in place. If we don't need the money, we can distribute that to investors, obviously. So that's not a problem at all. Reserves are $40,000, which is over 3 months of operating expenses as we have it underwritten. And also when we say conservative underwriting, in the first year, we always assume we have more expenses than the seller had in the previous year when we look at the financials. And there's multiple reasons for that. The main ones are really that property tax will get reassessed and they're going to go up. So our expenses right there will be higher than before. Secondly, we have our own management structure, and they might be higher or might be lower than the previous owner does. And the previous owner, they have a community manager on site. They're paying pretty well. And we, have our own property management company that pays, the company, the deal pays the company 10%, which is cheaper than compared to like a third party company, like a property management company that is. So, as I mentioned earlier, it's an off-market deal. So the off-market wholesale fee is $50,000. Well deserved if you look at how cheap we got this deal for 131 lots. It's a really, really, really good deal. And our relationships really made that happen. Acquisition fee is 3% of purchase price, which is $82,800. And all the closing costs are $125,000 combined, which includes the PPN creation with our SEC attorneys and everything. That alone is in the tens of thousands of dollars. And then also prepaid insurance, prepaid taxes, etc., loan broker fees and everything, origination fees. This stuff adds up pretty quickly. That's why the number looks pretty high, but considering the percentage to a purchase price, this is right in line of previous acquisitions that we had.
All right. Thanks, Matthias. So yeah, we're using 5-Star Bank. We've used them before. They're one of the big ones for mobile home park lending. They're in Northern California, I think. Next time I go to California, I should stop by and say hello to them. Anyway, so, because they know us, because we worked with them before, because we are working with Princeton Capital Group as loan brokers to really get us the best deal, they came back. They loved this deal. They said, they'll give 70% loan to value. They're giving us a 10-year term and 30-year amortization. The interest rate, we were really, really, really happily surprised to see it's only 6.7%. I think we underwrote it 7.5 or so, if not 8, honestly. So like 5-Star, they always have a 5-year term for the rate, and then it resets at year 6. So that's pretty standard from them. And I'm pretty sure Judah asked specifically for 12 months of IO. And that's again why it's so good for us to work with the same loan brokers, is that they really get the best structure for the deal, and are able to paint that really good picture to banks. Yeah, I love working with Five Star. They're all good people. I met them at conferences and whatnot, and it's we're like super aligned with them and with Vanderbilt and other big banks. Like, we treat all these banks as our partners because really they're the ones putting up the most money. So if a bank loves a deal, we know that we're onto something. If a bank says, no, I'm only going to give you 50% LTV, we know, okay, we're probably overpaying for this. We need to go back to the drawing board. So we definitely treat banks like partners, and keep those relationships, really make sure to recognize how special they are. So for this investment offering, we're doing a $50,000 minimum investment. Your projected return is 2.x equity multiple over 5 years, and that's with cash flow and exit. It has an 8% preferred return, meaning before any cash flow is distributed, you're going to get 8% on your money. And the LP GP, the limited partners to general partner split, is 70-30.
So as we mentioned a couple of times, we are moving from quarterly distributions to monthly distributions. We are really excited about this for our investors, to the point that we created one slide just for that. So just so you know, 90 days after we close, investors will get their first distribution, which is pretty cool.
I'm excited about this. This is, we're always like, how can we treat our investors better? How can we, do something so you guys come back and say, oh my gosh, I treated us so well. Either I want to continue investing with them, or I want to tell my friends so they can invest with them. So that is always like very top of mind for us. How can we treat y'all super, super well so you keep coming back?
It's a good deal when it's on its own slide. It's such a big thing for sure. And Tim and I and Vinny, we were in our retreat a couple of weeks ago, and we were really sitting there at the campfire, like, how can we stand out? And that's one of those things we came up with. We just have to do something more bold than others, and then we have to find the right deals to do so. And I think this one, it checks all the boxes, obviously. On the screen right now, everybody can see that we basically over doubling the NOI. That's where really the high equity multiple is really coming from. And it's really simple in how we add that value. It's really just by increasing rents and putting more paying units into the parks. So the plan was to put a new home in year 1, and then 2 homes each year from year 2 into year 5. And those are paying units, obviously. So that automatically drives the income up. But there will be immediately rent-to-own units as well. So we're not going to try to actually put new homes in and make them rentals. We want to do them on very long-term rent-to-own contracts, which we have no repair maintenance responsibility in their new homes. So we attract actually a not very good tenant base, because they're not cheap homes. They're cheap compared to like stick-built homes, obviously, but in the mobile home park world, those are expensive or more expensive homes. So that's how we drive the value up, or the net operating income up so high in this case, because we can increase rents significantly from 300 to really, we could do it in 475 one day after we close. Of course we won't, but if you will be in year 3, you will be caught up to the market rent today. So if rents actually keep climbing, it's going to be like 500, 525, 550, maybe 3 to 4 years from now, just regular inflation. It's not really hard to fathom, to think about that rents could go up from today, even in a just stagnant market, $50 to $75 3 or 4 years from now. If you think back, if you were renting, if rent goes up over 3 to 4 years for like $50, it's probably very expected in 3 to 4 years. And it's kind of what this is too. And just catching up to market is really a big thing here. And on the next slide, we go a little more deeper on the returns as well, and how that's constructed. So the target equity multiple is 2.83x, which is extremely strong. Our North Stars do at least 2x or more, and this one almost hitting the 3. And again, this is with conservative underwriting. I think we can go easily into the 3s if we info a couple more homes. and then have them, contribute to income, so to speak, and then drive the NOI even higher. So in this table, and of course, everybody can get the this offering memorandum where you can digest the numbers. I'm not going to bore you with the exact numbers, but it shows how much you're investing by $50,000 brackets, what cash you can expect per year, and also what the total distribution is in those 5 years, and also the proceeds from sale, and then it kind of combines it all together, and then you get your return numbers. IRR is like in the mid 20s in average, so that's extremely strong. And cash on cash is pretty good here too. It starts in year one already at 7%. And every deal is a little bit different, right? So if you see an equity multiple hanging out there, it's always, how is that equity multiple delivered to me? You have to ask as an investor. So some deals, like you get no cash for 5 years, like apartments like this, and everything accrues, and they're gonna do their value add, and then after 5 years, if you prayed hard enough for multifamily, then you get your entire returns in the back end with the accrued preferred return, and then like the huge check in the end, basically. Not all are that way, but many of them are. Mobile home parks, thankfully, they're cash flow really nicely from day one if you buy them right. And many of them do, especially the off-market ones. We have a really low entry price. And this one has a 7% cash on cash all year one, and it just grows. If I go into it, it goes up to 13% cash to cash in year 5. So it goes from 7 to 10 to 11, almost 12, then 13% cash on cash return, which I see on my numbers. So this one has a very high equity growth from the value, obviously, but also immediately or cash flow as well. That's why we can pay an 8% preferred return right away. So in other deals, they're more cash flow heavy, but not value adds on like equity growth in the back end, like appreciation. Because it might not be like might be like a class C, class D market, right? This one kind of has a little bit of both. This is not an Austin, it's not a Dallas, it's not a Raleigh, North Carolina, but Albany is not a terrible market. It's a really good market actually, with a strong employer base. But we're also increasing the cash flow by increasing rents and bringing more units in. So you have a little bit of both worlds, which is rare. That's why I'm preaching that right now, because you don't necessarily get a high equity multiple most of the time and have cash flow all along the way after 3 months monthly, and then get a big check in the end too. So normally it's one or the other. One you should get sacrificed, and this one strikes a really good balance. So really happy with that.
Awesome. Thanks, Matthias. I want to also say, like, Matthias was mentioning we can get up to 3, maybe more. And we're very conservative in our underwriting. So our whole goal is to underpromise and overdeliver. And with all of that, we want this to do better, because then we get paid more too. We don't get any cash flow unless you guys are getting your full pref until, when we give you that, then we're getting cash flow too. So we're super aligned in our incentives. I want this to do super well. So I see that ACH hitting my account every month in the same way that I want it to be hitting your guys' account. But yeah, and then here's the tax savings, and straight from Madison Specs, from Eden. We all know that 100% bonus depreciation's back, or maybe you didn't know that, but now you do. So they did the big beautiful bill. In it there was, okay, we're going back to 100% bonus depreciation, and because of that, people are saving so much in taxes. I love this. So they're always very conservative in their proposals. I mentioned earlier about how some of our investors saved 150,000 roughly for every 100,000 that they put in. With that deal, the proposal was way less than this. So obviously, we're not guaranteeing anything, but consistently I'm seeing them beat their proposal numbers. So there's definitely opportunity for anyone who has any kind of tax burden. But we really kill any other commercial real estate asset in terms of year one tax savings. And I mean, you pair that with the cash flow and the equity multiple, every deal we have is a home run, and this one especially.
So transparency is key, right? So after we close and we partner, you start getting monthly newsletters. You have full access to the investor portal. And if you ever need to reach us, you have full access to Matthias, Tim, and I. And the key thing is that you will always know exactly how your investment is performing, right? And Tim mentioned earlier how we pride ourselves in treating our investors right, and we always try to find ways to improve that. We always listen to feedback. We always try to grow. So again, if in summary, you have full access to us, and you will never be in the dark in terms of how your investment is performing.
And we'll let you know the good and the bad. Like, we don't hide anything, stuff happens, but we will let you
Yeah,
know what has happened and let you know what we do about it.
absolutely.
We pride ourselves in our honesty.
All right. So to wrap up, Albany, Georgia mobile home park is cash flowing, and it has significant upside, as you can actually witness today in today's presentation. So you're investing alongside an experienced team that's already proven with this model across multiple parks and markets. And we already own 2 parks in this market with low operational risks, strong fundamentals, and aligned interest. This is a great opportunity to build wealth through affordable housing. So yeah, I want to thank you for your time today, and we look forward to partnering with you all. And with that said, I'll open up the floor for any questions you may have. We did so well. We have no questions. That's awesome.
Hi, can you hear me?
Yes.
So this is Chris Armstrong. Thank you so much for that detailed presentation. Very, very appealing deal for sure. I joined late because I'm at a baseball game, but my question is, it sounded like the plan is going to be to add 1 additional home the first year and then 2 each year after that. Was that correct?
That is correct.
What is the likelihood that number is more than 2 homes in year 2 and afterwards? And follow-up would be, why would you not try to fill the entire park to 100%?
Infilling 47 homes would be a tremendous capex amount and also tremendous bandwidth burden. So the amount of labor we have to deploy all at the same time for getting them, all leased up and managed, not managed, but leased up, and also getting all the infrastructure in place all at once. I think we would have to pull so much capex in early. I think that would decrease the returns tremendously out of the gate. And to your first question, likelihood, yes, it's going to be a lot higher. I think it's very achievable to do 3 to 4 more, or 3 to 4 in total instead of 2. And normally you don't go more than like 7 or 8 a year in general. So even with that high number, you won't be able to reach 47 within 5 years. So just a little example, maybe you guys know like Brandon Turner, and we have very good connections to people. We know Brandon personally as well. And he has an infill department because he has 14,000 units, which has apartments and storage in it. I get it. But the majority is mobile homes, and they have an infill manager. And we talked to them before, and they said they underwrote deals in the beginning where they said, oh, great, we have 50 empty lots. Let's do like 10, 15 a year. And then we're just going to have this thing filled up, and the numbers look great. What actually happened is like they ran into roadblock after roadblock after roadblock because we also are dependent on the manufacturer's lead times because they can only build so many homes at a time. They usually have a 3-month lead time. Yes, you can do several at once, but if there's other people buying at the same time, like other operators, it might make it difficult to get that infill done in a timely fashion. So we asked that person that works for Brandon Turner at Open Door Capital, and they never do more than 7 a year, and that's when you're really killing it. So that's why we do 2, because it's also not a Dallas, it's not a Houston where it's like a huge MSA, but it's a good secondary MSA. Have a conservative numbers, you can definitely reach the returns that we're promising, but we can certainly go higher than this, and that's what we're also aiming for.
Thank you for that answer. I appreciate it.
Absolutely.
I think that's what makes this deal awesome, right? We don't have to fully add all the homes to get the numbers that you're seeing. We're being extremely conservative. And like Tim said, we want to, under promise, over deliver, right? What's the point of saying we're going to infill the entire park and then, we run into issues? That's not what we want to do for our investors.
Plus, like, yes, we're going to try and do more, but we will also likely be leaving meat on the bone for the next buyer.
Absolutely.
So it will be a lot easier to sell and to get a much better price. So it's, everyone wins. We're always cognizant of like the whole business plan from before taking over to operating to after, to exiting. And, we want to make sure that things can be relatively seamless. And we know from being in this industry and seeing what other people are looking for that leaving some meat on the bone is a big deal.
That's an excellent point. It's exactly what's happening right now with the current sellers because they did a tremendous value add by really turning the park around. So, also to highlight, the current community manager is living in that community for over 20 years. So, in early 2007, he moved in the community. He knows everybody in and out in that community. And he said when the previous owner took over, about like I think it was 2019, right? Tim, I think 2019 they bought that park, the previous owner. They did the same thing what we are doing. They're buying a park that needs some love, they put some love in, and then leave some meat on the bone for the next guy, and they can bring it to another level and we can sell it. Because if you extract 100% of out of the value out of the property, you will have a hard time actually selling it later to somebody else that want to do the same value add and extract value out of it. So I think this is also a very important point to highlight here because like that's what the sellers doing right now. They removed all the homes. They had a lot of drug deal activities a couple of years ago, which they got rid of. They have a really solid tenant base right now. Got it all cleaned up. There were a lot of homes that had to demolish, so they put a lot of capex in, and we saw it in their financials. There was a tremendous amount of capex they spent on demoing homes, which we don't have to do anymore. They really just cleaned it up, and now they say, okay, this is nicely managed right now. We didn't extract the rent value as we could have or should have, however you want to call it. But the next guy can come in, increase rents, put new homes in, and then get tremendous value out of this. So that's why we're here.
Okay, I see some questions in the chat. So the estimated price per occupied lot is approximately $33,000 based on 131 lots with 80 occupied. See, yeah. Given Albany's secondary market dynamics and population decline, this valuation seems competitive but not unusually low. Could you compare this pricing to recent MHP transactions in similar secondary markets in Georgia or the Southeast, focusing on cap rates, NOI multiples, and per lot valuations?
Yeah, that's a good point. So, which question should we answer first? Let's see. Yeah, it's the evaluation is correct. 33,000 per occupied lot. That's correct. Just how we look at the numbers is, per lot. That's the total lot amount. Obviously, that's where there might be a slight difference. But if it's 80 occupied, yes, it's 33,000. But it's even that is under the 100x threshold by a very, very long margin, obviously. So compare this price to recent mobile home transactions. So usually they transact like in the $50,000 to $60,000 a lot range very easily, especially when they're getting sold and stabilized. And then Tim has an awesome story too, where somebody owns a lot of mobile home parks in Albany, and they try to sell for like $100,000 a lot, which that's anchoring high, very high up there. But you can dive a little more into that story. But it's not unusual to have a stabilized park where it's all town homes have a higher valuation. Over the 100x rule, if you will. And there's some markets out there like Raleigh, North Carolina, I always like to pick on. People buying there for like $90,000 to $120,000 a lot. So even though the lot rents might, just be $600-700 in that market. So, and we see the same in Georgia. They're transacting easily in the $50,000-$60,000 range, depending on the area, of course. But we bought a lot in in secondary markets, also in South Carolina, North Carolina. And we see really low cap rates for selling. As well in the 6-7% rate as well. So many of those mobile parks live and breathe and are very powerful in those secondary markets because it's usually where more affordable housing is needed a lot. And I think that asset class is really powerful there actually. If you want to have multifamily apartment complexes, you want to be in the big cities, right? Because it's where population lives, they want to have amenities and, more luxury, and stuff like that. But the mobile parks live in the outskirts, or like in a secondary market outside of a bigger city, etc. So they're performing really well there.
I want to also speak to so the valuation seems competitive, but not unusually low. So we don't like just look at price. We're not just like, okay, am I buying at 65, 70 cents on the dollar sort of thing? It's like, no, it's the whole 5-year business plan. If we can come in and, do some upgrades, do some modest, rent increases, bring some homes in, if we can underwrite and it makes sense and we can all look at this business plan and be like, yes, I love that because it's easy or it's easy-ish. It's something we've done time and time again. We can do it again. If we look at that, then it works. I'm not, we don't go back and I'm lead acquisitions, right? So when that happens, I don't go back and I try and beat up people on price because that's just not how we do business. We want everyone to win together. So yeah, like the deal is great. The pricing is good, but it's not like, oh my gosh, we're stealing it from anyone. That's not how we do business.
Yeah, the value add is the part where the money's made. Of course, when you buy real estate, you make the money when you go in with the right price. It doesn't have to be, you don't have to rip somebody off to have a good real estate transaction, to Tim's point. That's what we're trying to do. Because if that's the case, or somebody feels like they were losing on the other end, it's probably your last transaction with them. And that operator that we are buying from, they have a large portfolio too. So this could be the start of they're selling more parks and they're gonna see how smooth the transaction was with us and sell more parks to us, which is more opportunities for investors because we have more opportunities coming down the pipeline. So to Tim's point, that's what Tim is really the master in, is making sure we keep a good relationship. Even if, like I mentioned earlier, we do a lot of offers. Even if we do offers, they're way under what they're asking for. We do it in a very respectful way and say, hey, this is our North Star. That's our business structure. And we know the right buyer. And sometimes we are the right buyer, like in this case. And then everybody wins. The seller gets a good price. We get a really good price too, purchase price. And we have still a lot of tailwind, so to speak, with the value add we can drive this up to. So you're really working yourself to a higher valuation where the entry price doesn't, I don't want to say it doesn't matter, but it's not the most relevant metric to look at, because you really can, what you can get it to is the most important part, especially in a certain time frame. And then where you enter, that kind of is like the range you're creating, the equity multiple, right? So we could have easily paid $3 million for this, it would be still nice, and probably like a 2.2 equity multiple. Would have been the worst price, yeah, but we still probably would have gone for the deal, but we got it down to 2.7. And we didn't see a reason to like push it down further because we saw the back end for that seller and saying, okay, this is all we can do. And then, okay, this deal works at 2.7. And here we are.
Yeah, we very much pride ourselves on our reputation. So every deal I go in and I talk to people, brokers, wholesalers, sellers, whoever, it's like, we want to make something work. If these sellers walked away and they, had a bad taste in their mouth with dealing with us, or, they weren't able to perform in a way that they wanted to, like, even if we were getting a killer deal, that's still a lose to us. It is very, very important to us that everyone knows, oh, I dealt with WCG. They were very fair. They were very good. We all walked away from this transaction happy. Not everyone got everything that they wanted, but everyone can at least walk away and say, this was good. We are walking away, and it is just a positive experience. Next question. Albany has experienced significant flooding and tornadoes, notably in 1994, 2017, and 2023, causing property damage and resident displacement. Has the property been directly affected by these events? No, and neither have like the other ones that we own. We bought the other ones in 2023. Before this question, I didn't even know that there was like any of that displacement stuff. So not saying it didn't happen. Clearly, it must have happened, but no, it didn't affect these properties or the properties that we have there. what mitigation measures and insurance policies are in place to manage future risks? Matthias, I'll let you take that one.
Sure, absolutely. So yeah, working with 5-star, they require us to do business interruption coverage anyway. If it's close to this Albany is not coastal, but it's close enough to have hurricane impacts and flooding risk as well. So they require us to do business interruption coverage. So if there's any like massive displacement happening, we get that gap covered by the interruption coverage. Not cheap, but safer. So if anything happens, God forbid, we at least have like income coming in as well until we can get people replaced or displaced and then replaced with somebody else. So yeah, that's all in place and accounted for, as we know the market really well. So we calculated for that, obviously.
Is any of this in a floodplain or flood zone?
No, it isn't.
Yeah, it's not in a flood zone.
Nope.
Good. All right. Did we answer all of your questions? We got a thumbs
time
up
for one more. I think we're on top of the hour, so one more.
Yeah. All right, y'all.
That's it.
Okay. So before we end, I want to just give a quick little update as well. Tomorrow we'll have another live webinar. We'll have a self-directed investment specialist who's going to present on how to invest on deals like this one using IRAs and 401ks. So be on the lookout for an email from us for that live webinar if that's of interest to you. But with that said, thanks a lot for joining. We really appreciate your time. I know you guys have busy days. So yes, if you have any questions whatsoever, feel free to reach out and we'll be in communication. If you want, we gave you access to a cash flow portal. You have the link. Go ahead and go in there, learn more about the deal. You have the OM. You'll find a PPM in there. You're able to soft commit. And again, if you have any questions, feel free to reach out.
And if you're interested, please don't sleep on this one. Please don't. Like it's going really, really quickly. If you're interested, we really want you to get into this deal. So thank you guys so much again.
All right,
Thank you for your
guys.
time.
Have a good evening. Take care.
Have a good evening. Bye-bye.
Have a good one. Thank you. Bye.